All right, so anyone who was paying attention to crypto a year ago remembers the whole FTX thing, right? Like it came out of nowhere. Just this massive crypto exchange imploded, taking billions of dollars with it. It basically was like if one of the big Wall Street banks just evaporated overnight. And we wanted to revisit FTX, but this time by taking a deep dive into their white paper. It's fascinating in a kind of morbid way, like looking at blueprints for a building that later collapsed, trying to see if the flaws were there all along.
Okay. Yeah, and it's kind of eerie, right? You start to see how these grand visions can sometimes mask underlying weaknesses. And in FTX's case, those weaknesses prove to be fatal.
So right off the bat, this white paper, it doesn't hold back on ambition. I mean, they weren't content with just being another crypto exchange. They wanted to be the dominant force in the derivatives market.
Absolutely. And they weren't shy about it either. They even went as far as to project that they'd reach levels of profitability comparable to like BitMEX and OKEx within their first year. Now, ambition is one thing, but this level of, I guess you could say, self-assuredness in a space as unpredictable as crypto, it does make you wonder what they were basing that on.
Right. And they devote a significant chunk of this white paper to like showcasing their all-star team,
Right.
right? All these big names from traditional finance, Jane Street, Optiver Susquehanna, even Google and Facebook.
It's almost like they were trying to build this dream team for the crypto world. But, and this is where things get interesting. Experience in traditional finance, it's valuable, no doubt. But the crypto world, it operates by a different set of rules. It's much faster, it's less regulated, and it's significantly more volatile.
So the question becomes, did FTX really grasp those differences or did they underestimate them?
That's the million-dollar question, isn't it? And this is where the role of Alameda Research comes into play. FTX's sister trading firm. The white paper really emphasizes Alameda's role as a backstop liquidity provider. Basically, they were FTX's safety net.
Okay, so on the surface, having a big player like Alameda backing you up, that sounds like a good thing, right?
Sure, in theory. But this close relationship between FTX and Alameda, it created a pretty significant conflict of interest that the white paper just doesn't really address. It raises questions about transparency and whether FTX users were really protected from potential manipulation or not.
So you're saying alarm bells should have been ringing from the start, just from this close relationship detailed in the white paper.
Looking back, yeah, you can see how the lack of independent risk assessment and this heavy reliance on a single entity, those are red flags.
Yeah, it's like they built this whole structure assuming Alameda would always be there to catch them, and then when Alameda itself became the point of failure.
Basically, the whole thing came crashing down. And that's where this whole no clawbacks thing comes in.
Yeah.
It's a big selling point.
Mhm.
They knew that clawbacks were a pain point in the industry. FTX wanted to set themselves apart.
So they were going to like eliminate this problem entirely. Pretty bold claim. How are they going to pull that off?
Well, they had this thing called a three-tiered liquidation model. So first they try to close out risky positions gradually. Then if they had to, their backstop liquidity provider would step in to stabilize the market. And yep, you guessed it, that's Alameda again. And finally, as a last resort, they had an insurance fund.
Sounds good in theory. But this is crypto we're talking about. Things can change really fast.
Oh, absolutely. Even the most sophisticated models can get caught off guard. And this whole model, it relied on Alameda being there to back them up.
And we saw how that turned out. It's like building a house on a foundation that's not so solid. Speaking of risky bets, let's talk about their centralized collateral pool. It sounds efficient, but also kind of risky putting all your eggs in one basket.
That's right. And that's a good analogy. So basically, instead of requiring separate collateral for different assets, FTX wanted to use stablecoins as the universal collateral for all their derivatives trading.
And this was supposed to make things simpler. But we've seen what can happen when you rely too heavily on stablecoins. The Terra Luna collapse comes to mind.
Yeah, not a pretty picture. Centralization can be efficient, but it creates a single point of failure.
It's like they built this fortress, but they put all the guards at one gate. And then there were the leverage tokens. Those sound like a recipe for disaster.
Well, they were marketed as a way to simplify leverage trading. So you could amplify your exposure to an asset without having to deal with all the complexities of margin trading.
So leverage trading, but simpler? What could go wrong, right?
Yeah. Well, leverage is a double-edged sword. It can magnify gains, but it can also magnify losses. And in the crypto market, that's a dangerous game to play.
Especially for inexperienced traders. And speaking of risky bets, let's talk about their native token FT2. They had a lot of plans for it. Burning tokens, using them as collateral, giving discounts on trading fees.
The idea was to create an ecosystem around the token. Increase demand, increase the value. But it's a risky strategy. Because if confidence in FTX goes down, the value of FTT goes down with it.
It's a self-fulfilling prophecy. And in FTX's case, it was a disaster. So we've We've gone through a lot here, lots of ambitious plans laid out in this white paper. But knowing how it all ended, what's the biggest takeaway for you?
I think the big lesson here is that even in the crypto world, you can't outrun risk management. FTX's white paper, it told a good story. Don't get me
Yeah.
wrong. All this innovation financial wizardry, but they pinned their hopes on Alameda, and that was their downfall.
It's like they were so focused on building this rocket ship that they forgot to check the parachute.
And look, I get it, the crypto space moves fast, but it's crucial to ask the tough questions.
Mm-mm.
What are the assumptions? What are the potential conflicts of interest? How will this all hold up in the real world?
Yeah. And those questions, they're even more important in a market as volatile as crypto. Things can change overnight.
It's a tightrope walk between embracing the new and managing the risks.
Well said. So as we wrap up this deep dive into the FTX saga, any final thoughts?
You know what I think is really interesting is how other projects are tackling these same challenges. Liquidity risk management, token utility. There's a lot to learn from FTX's mistakes.
Absolutely. And for everyone listening, remember, this is just one piece of the puzzle.
Hmm.
The crypto world is full of stories like this. So keep asking questions, keep digging deeper, and who knows, maybe we'll feature your question in our next deep dive.